Earlier on, we examined price oscillator, a trend indicator which is plotted as the difference between two moving averages. Gerald Apple designed an oscillator on similar lines which has several distinguishing features. Its full name is Moving Average Convergence Divergence, or MACD. The author gave quite rigid parameters for the exponential moving averages which lie at the base of this oscillator. Here, take a look at this. The first part of MACD is the difference between two exponential moving averages for 12 and 26 periods. It's drawn as a solid line. We'll call this the fast line or the main line. And the second part is an exponential moving average of this difference for 9 periods. It's drawn as a dotted line on the chart and it's called the signal line. Of course we can experiment with the time period, but please note the selection of the time periods depends on the time scale of the price chart. For hourly charts, the values of N1 equals 6, N2 equals 24 and N3 equals 3 can be applied as proposed by Benjamin Safin. For daily charts, in addition to the previously mentioned values, the values 9, 19 and 9 can be used as per the famous trader Di Napoli's recommendation. For daily charts, N2 is around a month, 19 or 26. For hourly charts it's 24. Parameter N1 is between a quarter and a half of N2. The parameter N3 signal line is selected from a range from 3 to 9. It seems we've said everything about MACD, how it's plotted and how to select the time parameters, but we've said nothing about what it's for. Don't we already have price oscillator and Ravi? Let's look at the last chart. Our indicator is based on the difference between two exponential moving averages, but the time period of the slowing moving average, if compared to price oscillator, is much smaller at 19, and for the faster moving average we've chosen a time period that is half as long as the slow moving average. We want to trace the dynamics of price change with the help of MACD, and by averaging the difference received we'll try and get trading signals to enter the market. The crossovers give the signals. Look at the points where the solid fast line crosses below the slow dotted line. That's a sell signal. And if it crosses above the slow line, it's a signal to go long. But before we examine the trading signals of MACD, let me run through some of the properties of this oscillator. When the baseline is above 0 and higher than the signal line, or when it's below 0 and lower than the signal line, we can assert that it's highly probable that the price is rising or falling. We've already seen this approach with price oscillator. It's interesting to know how much of a chart would be shaded as reliable information. It may surprise you to learn that on daily charts of the major currency pairs, more than 60% of the time will be shaded. For almost 2/3 of the time we have quite reliable information on the market direction. And it's about 50% for hourly charts. As you can see, the theory that the reliability of the information rises as the time period increases is confirmed again. We should note that we've examined MACD with Di Napoli's parameters 9, 19 and 9. On a rising market, each oscillator high may become a possible point of reversal. Immediately after such peaks, unshaded areas appear on the chart. They often predict a divergence, something we should be very familiar with by now. We've got a double top or double peak on the price charts and two falling highs on the indicator chart. So what can we do with the sell signal? It's evidently too early. We already know that answer. Only support lines and levels can confirm if the trend is over yet or not. Until there is a breakout, we needn't be in a hurry to remove such a pleasant colour or to leave such a profitable trend. It would be great to know in advance where the resistance level is which the price will reverse from. But is this possible? It's not only possible, it can be done pretty often. But we go into that in our film on wave analysis. At the bottom of the market, a divergence looks like the mirror image of the price chart above. Here it is. Double falling troughs or a double bottom on the price chart and two rising troughs on the MACD chart. We'll draw our lines and levels again, but this time they'll be resistance lines. And again, we won't buy till the price chart tips us the wink. Practice makes perfect. And let's repeat once more that there are some things that will help us identify reversals on a price chart and consequently confirm the signals of MACD. They are the signals of Japanese candlesticks, fundamental news, support lines and trend lines, and the oscillators we've already reviewed, RSI and stochastic. But up to now we've only talked about trending markets. What happens when we are in a trading range? We've already seen similar examples. How can MACD help us here? Remember the alligator? It's based on exponential moving averages too. The jaws close and moving averages twist against each other. Surprisingly, a daily MACD can be more of a hindrance than a help. Its signals lag and we could buy when it's time to sell. So, we examine this situation thoroughly in terms of hours, not forgetting to use the borders of the range from the daily chart. We plot MACD with parameters 6, 24 and 3 following Safin's suggestion. Along with support and resistance lines and levels, we include RSI and stochastic. And I should repeat everything I said about trending markets as well, word for word. Now, let's get back to our battle again. Well, maybe I was getting a bit carried away when I was talking about a battle. What we study here is not how to battle the market, but how to go with its flow. And that's half the battle.